Testing. Hello, everyone. I hope you are all well on this Friday before Christmas, and I'm doing pretty good, actually. I had my birthday yesterday, and the wife got me tickets for me and my son to go watch the Red Wings on Sunday. And I guess my son thought since I got my ACL torn and I can't play, the next best thing is to go watch it. Well, you know what? He's a smart kid. So Sunday we get to go and watch some Red Wings, which is awesome. Today, however, we are going to talk a little bit about the housing industry because I think it is important. The housing industry, of course, is one of the largest industries that we have in America, and it's a good indicator on how the overall economy is doing. So, Tom is obsessed with the housing market and looking at housing prices nearly every day. So, it's just one of those things that we like to look at. And in order to understand the housing industry, you also have to look at the CPI, which is the Consumer Price Index. So we kind of want to get into that to get around to the housing, to get around to the economy, to get around to how the stock market is doing overall. So let's get into that. Let's go into here. All right, so the consumer price index is what the Fed, and one of the indicators that the Fed uses to raise or lower the interest rates, which in fact, which actually indicates how the housing market is going to do. It's what the mortgage rates are going to be, and of course, bank loans as well. So when we look at the consumer price index, what is that? It's basically a basket. If think of it as a shopping basket that you put everyday goods into: bread, eggs, milk, gasoline. It also has energy costs in there, but it's basically what the average consumer buys on a daily basis and the prices of those goods. So if we go into our friends at Investopedia, how is inflation measured? Well, it uses the consumer price index. So the most commonly quoted inflation rate is the consumer price index produced monthly by the U.S. Bureau of Labor Statistics, or the BLS. Officially, the consumer price index for all urban consumers, or CPIU. The index reflects the changes in average prices paid for products and services paid for day-to-day use by 93% of Americans, based on a sampling of retail prices. Separate sub-indexes are produced for food, energy, and all other products. So, in a nutshell, that's basically it. There's a lot to this. There's a lot in the index that you show, and I'll give you a little rundown of that. But not to bore you, unless you really want to see that. So we go into the consumer price index. One thing that this showed, going back to the last 3 or 4 months, is a trend of going lower, so lower prices, which if you are watching the news, Trump just came out and said, hey, the CPI is, and inflation is down to 2.7%, which is under 3%, which was great. However, I'll show you in a minute, that is maybe a little skewed. So if we go into the Bureau of Labor Statistics and go, this is, a little hard to find, but you'll find it. You got the percentage changes in CPI for all urban consumers. You got food and energy, apparel, vehicles, you name it. However, we go over to October and November, we see a lot of empty spaces. So basically what happened is they were unable to collect the information for October and November. They've got a little bit of it, but the surveys and the labor it took to collect this data was not done. So when we look at a 2.7% inflation rate, they guessed. It was an educated guess based on the prior statistics, but it was a guess. And if we go into Wolf Street, they have an article about this as well, that it may not be as accurate as they say. So he has that nice little graph here. And he said, this is a screenshot of the CPI summary table. You see that nearly all the entries for month-to-month entries for October, November are missing. The exceptions are the entries for the BLS relies on non-survey data, such as gasoline prices and new and used vehicle prices. So they go to JT Power to get all the vehicle prices for that. They collect the data and give it to the Bureau of Statistics. All right, so with that, what do? Not much. Because without data, you can't come to a reasonable conclusion. This affects how the Fed does interest rates. They just lowered it by a quarter, which didn't really hit the housing market too much. It usually takes a little while for the housing market to react. But when you look at the housing spending, it's not great. So basically what we have is we have a lot of boomers that have houses, they're retiring, they're selling their business, they're moving to lower housing, like smaller houses or retirement homes or something like that. And they're trying to sell their home. Well, a lot of their wealth is built within their house. So they had it for 20, 30 years. They paid it off. They have all this equity. They want to get out of it. And they're told that they could get $800,000 for it, or $1 million, or $500,000, whatever it is. And it's overinflated. So they're trying to sell it for what they think, or what they're being told by realtors that they could sell it for. And people are not buying it. And it's going to be millennials. Because Gen Xers, I mean, I'm a Gen Xer. We have kids. We have our houses already. We're pretty set into where we're living, unless we have a life change, like we change jobs, or get fired, or move to a new state, or whatever. So it's really the millennials up and coming who are buying these houses. Well, they can't afford it. So there's an impasse. There's a lot of supply. There's not a lot of demand right now. And what they need is housing to go down. So the prices to go down. And this is one of the things that Wolf is talking about, Wolf Richter here, in his most splendid housing bubbles in America. He says there's 33. This came from the Metropolitan Statistics area. So basically, this is, where's it at? In some markets, prices of mid-tier single-family homes, condos, and co-ops have sunk substantially from their peaks in 22 and 23 and 24. In other markets, prices have continued to rise, though at a much slower pace than in 21 and 22. Here we track 33 large and expensive markets by Metropolitan Statistical Area, or MSA, census-designated urban areas, often consisting of multiple cities. So what he found is that prices are in fact down from their 2020 peaks, which is good, but it's not enough. So if you look here, like Austin, from 2003 to the 2008 bubble here, it declined, not much. Austin did pretty good, but look at the bubble that has come out of that since 2022. And then we can see housing prices are coming down a little bit. And that's one of the biggest ones. As we go down, you can see the housing bubble burst from the San Francisco, Oakland, Fremont areas, and the subsequent bubble afterwards. I mean, this chart, if true, indicates that we are in a housing bubble, and it will eventually pop. And every market shows the housing burst from the 2008 mortgage-backed securities problem to now. And it's in almost every market, it's worse, much, much worse right now. as we go down, we see just every single. So Las Vegas had had a huge bubble pop in the 2008, but they're still not quite double, but a lot of places are double or worse what they were in housing prices. Keep going down, and this is from Zillow. Baltimore, Columbus, all over the United States. And these are the large metropolitan areas. So if you live in a smaller area or like where I live, housing prices are pretty stable and they're still kind of going up. We see a lot more supply that people are trying to sell. One of the problems that they have is, again, they're trying to sell it for those peak prices. Nobody's buying it, and so they're taking them off the market. Yeah, keep going down. So yeah. So as you go through the CPI data, we find a problem where we have this little peak here that it goes down considerably and then just flattens out. So this is where the data is missing. And I don't know if they're going to retroactively go in and fill that in once they get the data, but this is what they're going on right now for interest rates. And the administration is relying on this to set prices. And of course, they're going to say that, hey, we're doing a great job because, I mean, look at it. It's down almost to the 1%. We got 0.7% to get down to the 1%, 2%. So here's the problem that Wolf states, and a lot of people are right on this. Lots of the things depend on the CPI, including the calculation of the inflation protection in Treasury inflation-protected securities, or TIPS, I-series savings bonds the government sells to retail investors, Social Security COLAs, and other adjustments paid to investors and beneficiaries. And they will all be underpaid for inflation. So if you're invested in any of these funds are going to be underpaid due to the inflation that's not being reported correctly. It should be higher than what it is. This also wraps into the stocks and bonds industry. So when you look at stocks and how people are investing in that, I'm still not quite there yet with my throat, but I'm fighting it, man. I will not get sick. This data also impacts broader economic data that is adjusted to inflation, including real consumer spending and real GDP, because the BEA, which produces those overall economic indices, use some of this CPI data, including OCR, for its calculation of the PCE price index and the GDP deflator, among others. It's causing serious issues with all of them, with investors and beneficiaries getting shortchanged on their inflation protection, and with inflation adjusting economic data getting inflated, which would, of course, suit the administration's narrative, which, of course, is good for them because they're winning the economy, right? But this is all bad for us because prices get inflated. Housing prices are still inflated. We need some sort of pressure to get released in order for things to be affordable again. Some things are less, eggs and whatever, but for the most part, a lot of products and goods are still more expensive, and it's not being shown. So we need to get interest rates down to a rate where people can afford houses. The housing prices come down to where normal people can buy them, and not just rich people. Not talking like super wealthy, but people have to make $180,000 a year to afford that $500,000 house that they are being sold, which 5 years ago, 6 years ago was maybe 180 or $200,000. So, so it's one of those things where it's an affordability problem. And people are saying, well, it's the tariffs that are doing it. Tariffs are taxing the foreign countries that are being imported. The importers are paying the price. They're passing it on in the price of goods. That's what's really causing the inflation. Well, it's not that simple because, yeah, sure, the cost of goods does inflate things, but it's not the only thing that does that. It's not the main indicator. So what they're doing is they're taking the tariffs and using that money to pay for the big, beautiful bill. And that is creating tax cuts for Americans. So in that instance, there is kind of a wash between the tax cuts that you're going to get versus the price of goods that are coming into the country. And they're saying, well, you could take that and buy American, right? I mean, it's not that simple either, because when you buy American, sure, it might be manufactured here, but it comes from all over the world. You follow the supply chain, and not everything is from America. So they have to break it down to, okay, it's 85% American, because 85% of the parts come from America, and it's assembled here. So that's one of the things that is really confusing about all this. And it's hard to wrap your head around. And who really has the time to look at all that? To go and do all this research and to follow the money, follow the supply chain, follow how the macro and microeconomics works with all of the goods and services that rule our daily existence, and how our jobs and pay, how much taxes get taken out of that, and where all of this is going. The stock market at the moment is still at record highs. It's pulled back a little bit, but it's still what the Schiller index, Schiller index is like the PE index is, I think, 35 times. It's either 32 or 35 times. Let me go look. I think it said 35. Schiller. So this is saying, come on. Ooh, right now it's at 39, which is huge. Huge. It's really saying that the stock market is overvalued. And that's when you got the Mag 7, that's 35% of the market. Something's going to give. Now, how that plays out in the future, I mean, your guess is as good as mine. I don't know how long they could keep this going and keep the stock market going up and keeping housing prices the way they are. But, I mean, looking at these graphs, and it's replicated throughout a lot of this. Where are you? There you are. It's clear that housing prices are overpriced, and they're going to come down, and there's going to be a bubble burst here in a year, 2 years, 5 years, I don't know. But it is way up to where it is unsustainable. And I think it's going to take boomers to die off, right? Or to forced to be gone into retirement homes or whatever, to age out and have their family not want that house because of the taxes and upkeep on it, sell it to get the money to split it off, Or the house goes into probate because they don't have a trust, or they don't have, a will that supports the house. And when that happens, then you're going to see house prices go down, supply which is there, will be even greater. Competition will be there, and housing prices will go down. And as we see, when that happens, you're going to see an economic shift. Now, I don't know if Trump will still be in the office or will be the next president, but hopefully you're going to see, one, some better reporting because we can't have 2 months of no CPI reporting, or we need to stop using how CPI is gathered and find a better way, which it sounds like they're trying to do. They're trying to find a better way to gather information to make sure that this is accurate and up to date. Because, I mean, without information, you can't make reasonable decisions, right? So how does this really affect your stock your stock portfolio? Well, if you're invested in the insurance protected funds and bonds, then you're going to feel this when the data comes out. And if the inflation comes out in higher, you're going to take a hit, unfortunately, which is crazy because it's supposed to be protection, right? Protection funds. As a normal investor, and what we do, we try to get a portfolio that will weather this, whether it goes up or down. I mean, our portfolio will go up, will go down, but excuse me, not as great as if it's a heavy in Mag 7 stocks, or if you have an index fund that's heavy into tech. When that dies, so does that index fund. And ours is quite a bit more diversified than that. So if we go into we always show our portfolio. Here we go. All right. So you look at our portfolio, we do have some tech stocks. We've got Intel. Man, see, this is the difference between streaming and doing a video, because I could edit all this coughing out. But we don't have much. I mean, we got 3M, Johnson & Johnson, General Dynamics, Rio, Merck. We have all industries in this portfolio, or at least most of them. Kimberly-Clark. And we're still doing pretty darn good. We got $10,000 gain loss. We're about $304 in dividends a month. We're at $106,000. So, after 3.5 years, this is what you can do. And whether the market crashes, we're looking at maybe a 20 to 30% loss versus 40 or 50 what the market's going to do. And if it's just, a standard 40% loss, we'll probably have maybe a 20% loss, which will come back. And no matter what this portfolio does, we're still going to get the dividends. It's still going to pay us qualified dividends every month. And if you need that money because the stock market crashed and prices are up because the CPI is out crazy and without data, then you could use that money to buy groceries, to fill up your car, to pay the car payment, whatever it is. And that's why we do what we do. Now, you could get an index fund. You can get ETF that has some of these in it. But I think that's what people you really just want us to shut up and tell you what to buy, right? Well, this is it. And of course, we're not your financial advisors, so we can't really do that. But you want something easy, and that's what ETFs and index funds are for. Now, if you follow this, I think this will do just as good or better than what the index funds will do. Because a lot of those, if you look into them, have the Mag 7 stocks in them. And it depends on what they're weighted, how far those things are going to crash. So that's basically where I'm going with the housing market. is you have to watch these things in order to find out what these stocks are going to do. Right now, it's way overweighted. The stock market is higher than I think what the 2000 crash was. So I think it was 20 or 25 times the Schiller PE. Right now it's at 39. It can't continue to go up indefinitely. There is going to be a pullback. I think it's going to be a pretty big pullback. Like the housing industry, I think when it starts to go down, will go down instead of a big crash like 2008 and the mortgage-backed security problem. I think it's going to gradually go down over months, so it's not as big of a deal. But I think the stock market is also going to follow that trend as the housing market goes. So we'll see. We'll see if it all goes. Maybe I'm full of crap. Maybe I don't know what I'm talking about. But we'll see in the next 6 to 12 months. Tell me what you think. If you think I'm completely wrong, go ahead, put in the comments, put it in the chat, and let me know. So yeah, that's pretty much what I had to say today. I wanted to get the whole housing market thing out of the way because it's a big one, and this is the reason why we keep looking at it, because as the housing market goes, so does the rest of the economy. All right. I hope you guys have a very, very Merry Christmas, Happy Hanukkah, or whatever it is you celebrate, or nothing. If you don't want to celebrate anything, bah humbug. And as always, happy streaming. No, that's Harris. Sorry. Happy investing.